So welcome everybody. I'm Kamal Hassan. I'm one of the managing partners of Loyal VC, and this talk is about the emergence of evergreen funds in private equity. And of course, private equity means private equity and venture capital, this sort of included together. Um, so why are we speaking on this? What do we know about it? Well, just to mention, we've been running an evergreen venture capital fund since 2018, which has invested around the world, it's the seventh most active early stage VC globally. And we've got a lot of experience at running a successful evergreen fund where people have been able to redeem successfully throughout the process. And this talk is really going to be focused on the industry in general. Happy to answer any questions have, not just about the industry in general, but about our own fund, how we handle our gates, etc., if that's of interest at the end. So yeah, if you look right now at the average capital endowment, the average capital allocation for endowments, and this is from the endowments, and then the left-hand side is from the National Association of Endowments, the U.S. You can see that they allocate 27% of their assets to venture capital and private equity, which, by the way, is just about the same as the 29% that they allocate to all equities, all public equities. So you can see they allocate about the same, and overall, in private equity and venture capital makes up the majority of their allocation to alternatives, which is about 47%. And there's a very simple reason for this. If you look at the returns by asset class for a series of different assets over the past 10 years, you can see that private equity and venture capital have outperformed even the US market by about 2%. And this has been a very good decade for the US market. So people are allocating a lot to this asset class when you're in an endowment. Now, if you think about how the allocation looks for individuals, it's very different. Family offices, ultra high net worth individuals, any individuals are allocating about, well, you can see for alternatives, it's anywhere, most individuals, it's in sort of the sub 5% range. Even for family offices, it's not even 20%. So this is a very different allocation measure. And by the way, I just want to highlight here that these two graphs here, this shows the amount of wealth managed by the different groups. And you can see that private wealth managed directly by individuals is about the same size as institutional capital. So not only are they underallocated to alternatives and underallocated to private equity venture, they're also about the same size as the market. And a number of people have started to realize this. If you look first, though, at why are individuals not buying private equity and venture capital funds, the short answer is that the funds are not designed for them. 99% of venture funds are designed for institutions. They have large minimums, for instance, $500,000. They are closed-end drawdown funds with punitive capital calls. So what this means is you will commit $500,000 to the fund, and they will say, hey, we'd like to start with $125,000 now, and you need to keep the rest of the money on hand for the future when we ask for it with a capital call, and we'll give you 30 days to deliver the money when we ask for the next batch. And if you don't deliver the next batch of money when we ask for it, there'll be very punitive terms. Because, of course, they're worried that they invest the first batch of the money. If the fund does poorly, then people are going to say, oh, the fund's doing poorly. I don't want to put any more money into this fund. And they don't want to take that risk. So the penalties, can potentially be lose all of your first commitment if you don't follow through on the capital calls. Now, venture funds are also illiquid. They'll liquidate in 10 or more years. Now, the fund itself, when set up, will say 8 years plus 2 year extension. The truth is, and this is data we overheard in a presentation by Adam Street Partners at Super Return, they said over 40% of private equity and venture capital funds take over 16 years to fully liquidate. So although you think it's liquid in 10 years, the underlying investments are not necessarily liquid. I've got one friend who's a venture capitalist in Europe who has not yet liquidated his first fund, and he's now on his fourth fund. because the top performing asset in that first fund, which has been marked up many times to a very high multiple to what he got in at, and is in fact the basis of success of his fund, is an investment they haven't been able to sell yet. The company's doing really well. The company just doesn't want to sell, and they haven't been able to liquidate that. Now, if you think about individuals, what do we want as people? Well, the first thing to keep in mind is the minimum investment sizes. Now, there is legislation, typically in many countries, about a minimum wealth threshold that you need to be able to invest in alternatives such as venture private equity funds. Typically, that minimum wealth is $1 million. So if you think about what's the amount that individuals want to invest, they want to invest $25,000, which is 2.5% of your wealth if you're at the minimum wealth criteria, and 2.5% of your assets into any one fund sounds like about the right level. So individuals want a $25,000 minimum investment. You want to invest what and when you want. You don't want capital calls. You don't want to be forced to invest money in an asset if your opinions have changed or what you're doing has changed, and you would love to have liquidity, because normal human beings aren't predicting out pension payments for 30 years from now, or payments from an endowment for the next couple of hundred years. They are reacting to opportunities that come up. They want to start a business, which they need to fund. They want to buy a holiday home. There's unexpected health expenses, whatever it is. Individuals want to get some liquidity, and it's pretty clear that they are going to accept quarterly liquidity, so that if you can get in and out roughly every quarter with gates, I mean, monthly liquidity would be preferred, but there's a lot of liquid products out there in the market, and it seems that there's general acceptance by individuals of something which is a couple of times a year liquid. Even if there's some gates, they will understand that. So because of this, this market opportunity, the fact that individuals aren't investing in private equity and venture, has caused a lot of big private equity and venture brands to launch evergreen funds in the past 4 years. So you can see in 2021, Apollo, Ares, Carlyle, Hamilton Lane, KKR, bunch of people launched evergreen private equity funds. Blackstone came out with one in 2024, and this has been a big success for them. If you look at the typical feature set, it's that $25,000 to $50,000 minimum I mentioned. It's quarterly or maybe semi-annual semi-liquidity, and the liquidity is typically done with a gate, which is a percentage of the assets that can be traded out in any one quarter, typically 2.5% to 5%, and they'll typically hold about 15% of the fund in cash to ensure smooth trades when people want to trade it. And now, in terms of, there's been a lot of activity in private equity, in venture capital. Our fund, of course, launched in 2018. In 2022, a group called Stepstone launched, formerly known as Greenspring. Now, there have been evergreen venture funds around, which are targeting institutions. Sequoia launched targeting institutions in 2019. Sutter Hill's been doing this for decades. But if you look about targeting individuals, the Stepstone product is probably the first one. And Stepstone has been very successful with this venture product. They've raised over $1 billion into it in just a 2-year period. So it's very clear there's a market demand for an evergreen venture fund, a venture fund which is as easy to invest in as a mutual fund. Now, one of the things which people don't always think about is the fact that because of these capital calls, your money is not fully deployed when you put your money into a venture fund. Now, if you're a pension plan with regular pension payments coming in, you are funding your capital calls out of cash flow, and this is less of a concern. But if you're an individual, you probably are holding cash in reserve for the future capital calls. If you've promised $500,000 and you know you might be asked for it at any time, you want to actually set that aside into very liquid investments so you can cash it out. And the result is that and this is KKR has done this lovely little analysis here, but they've said, look, if you want to triple your money, and this is what it all comes down to, is how much money you get back again from your fund, it doesn't matter what the IRR numbers are. You care about cash on cash. How many dollars do you get back? Or you care about an ROI. But venture funds and PE funds always quote IRRs. And you can see that if you want to triple your money with a drawdown fund, you're going to need about an 18% IRR to get that tripling of the money, because on average, over half your money is being held in lower returning liquid assets over the life of the fund. Whereas if you invest in an evergreen product, that 11.6% IRR is enough to give you that tripling of your returns, because these evergreen funds can be fully, when you write the check, it's fully deployed. And then when you cash out, you get the cash back to use again immediately, rather than having these awkward in-between stages. Now, just to show you what this looks like in real cases, this is a couple of different data sets here. And I want you to emphasize, first of all, Cambridge Associates they've got their institutional grade US VC index, they call it, which they make public. And they publish the IRR, the internal rate of return from this. And you can see this is the blue line here. If you adjust that for the fact that over half of that money is deployed into liquid assets with about a 6% return, you get this dotted line here. So you can see there is a dramatic difference for what you see from a drawdown fund on paper. And you can see our fund has roughly matched that as an evergreen fund. But if you compare our returns versus the Cambridge Associates, you can see there's a dramatic difference. And I just wanted to emphasize what a difference this makes to your real returns, having all of your money deployed rather than having it in a drawdown situation where a lot of it's sitting in your control, waiting to go in or coming out before you were ready for it. By the way, there is a third line on here. There's different data sets in the industry. This third line here is there's a group called Carta, which does back office for a lot of new venture funds. And you can see here the line in purple is the returns. Carta is now publishing their data for all of their venture funds. And if you average sort of all the vintages that they've run so far from 2017 to 2022, you get a line that looks like this. So just to compare, I'm going to drill down a second because there really are only the two groups out there. There's the Stepstone Fund and the Loyal VC Fund. And if you look at the Stepstone Fund, I wanted to emphasize the terms can be very favorable to the manager. And just looking at the Stepstone Fund, launched in 22, 1.1 billion now. First of all, is a very US focused fund. They've only got 8% of their fund is in global investments. It is a widely diversified portfolio, 1,500 underlying companies. And the reason why is because it's largely operating as a fund of funds. 70% of the money that's invested goes to 60 different fund managers. 30% is invested directly into these fund managers' companies by Stepstone. And you can see if you look at the fees, I mean, they quote a 2.35% fee, but you're also paying fees to the underlying manager. And if we include expenses as well, your total fee load here is 4.64% annually as a fee you're paying. Plus, there's a sales load on top of 3.5%. Plus, there is a carry you're paying, which works out to 30.8%. as a direct carry, and that carry is taken annually based on a high water mark, a monthly high water mark for the fund. So you can see here that you've got, this is a very profitable product for Stepstone to go out and offer to the public because the fees are very significant. Now, it doesn't have to be that favorable to the manager. You can see with our fund, yeah, it's a global fund, but our net fees come in to almost half of those of Stepstone, and of course the carry. So we do a standard 2 and 20. I mean, it's a very simple. All of our carry is deferred until you redeem. We don't believe in taking carry on high water markups, but this is just to say, look, this is a very popular product right now. This ability to go out and invest directly into a venture type product. So it's very popular, but you don't have to, it's very popular. It's also very profitable for the big guys, but you don't have to necessarily buy from the big guys. So let me talk a little bit right now about what is probably the key issue for open-ended funds, and that is valuation. And if you think of a traditional drawdown private equity or venture fund, the valuation is done very differently when you're buying assets or when you're reporting the price to the LPs. So when you buy the assets, the investment team is sitting down and saying, what are we going to pay for this asset? And your key consideration when you're trying to figure out what you're going to pay for the asset is making money. It's like, how much do I want to pay? Because I want to make money and I want to make sure I don't overpay for the asset. And then you start looking very closely at things like deal terms, who's in the team. If a key team member leaves, of course, if you're going to invest at all, you would do it at a considerably lower valuation. Maybe there's an acquisition being discussed for this company. You would reprice it upwards because you know there's a good chance you can flip it soon after acquiring it. If you think about that's how we all price when we're buying the asset. Yet the funny thing is, for a traditional fund, once you've bought the asset, it's an illiquid fund. So valuations, which will happen once a quarter, typically once a quarter, valuation becomes a very accounting-driven process. It's very much about operations, and they're no longer thinking about making money. They're thinking about defensibility. How can we set up simple rules that are defendable? By the way, this is often audited. Auditors love having a simple, repeatable process which can just be executed. And they're not trying to say that the key consideration is making money, getting the price right. They're saying, how can we defend it? So all of a sudden, if you're buying an asset, you care a lot about deal terms, and yet when the valuation, the standard rule of a valuation team is to say the share price, if I have a share price for preferred shares, then common shares are worth the same as preferred shares. Now, we all know that's not true, but yet that's what they do. It's a simple rule. There's a transaction, the company shares. It doesn't matter what the terms are, whatever the price is of the shares, that's the price of all shares. If a key team member leaves, and I've had this conversation with other VCs, I've said, what do you do if the CTO of a company leaves? Do you adjust the valuation? And they say, of course you don't adjust it. That's not a material factor. I mean, sure, we don't like the CTO's left, but maybe they'll replace them, etc. Whereas if you were buying the asset and the CTO left, you would go, of course it's a different company. Similarly, if there's an acquisition being discussed and maybe they've got sort of verbal back and forth, maybe there's a couple of emails, but nothing has been signed yet. Well, the accountants are going to say, well, until it's signed, you don't take that into account. Whereas normal human beings, we can follow along and see how far along it is. We can go, okay, well, this acquisition pretty far along. This should influence our pricing. And something you will see used a lot is a DCF, a discounted cash flow, as a way to justify the price, which you will do in either venture or private equity for valuations often set by your auditors, your accountants. And yet, if you think about venture capitalists, we never use a discounted cash flow model to set the acquisition price. You would be laughed out of the room if you said, here's my DCF model of why this company is worth this much. So yet this is still the same thing done. And the reason this all happens is, look, a drawdown fund, the quarterly valuation is for reporting only, and you can see how good or bad that quarterly valuation is by the fact that secondaries will often trade at a 20 to 50% discount. So there's clearly a real trading price, which is what you buy the secondaries at, which is different from the quarterly valuation. Whereas if you think about an evergreen fund, well, an evergreen fund, when you do the quarterly valuation, this is not a theoretical exercise. This is what buyers are going to pay for those assets, or sellers are going to receive for those assets. So you need to price as if you're making the investment, and it needs to be an investment. You have to keep in mind all the factors you do normally when you make an investment, and you will see as a result that evergreens and secondaries are trading at or close to par. Now, I did want to talk for a second about the discounted cash flow and why it is so inappropriate in venture capital, yet it is appropriate in private equity. If you look here at the lines in purple, these are the probabilities of a different deal receiving this outcome. So, for instance, there's a 57% probability that a private equity deal here will receive between 1 and 5x, typically about a 2.3x. So you can sit here and say, look, in a private equity portfolio, you've got a roughly normalish type distribution of outcomes around a relatively relatively predictable midpoint goal. And this is a sort of place where you can forecast a single midpoint for the future. There's a probability it goes back and forth from there, but you can model out future cash flows. The thing about venture capital is if you look here, the bars in green, first of all, you can see half your deals fail altogether. So if you wanted to take the average case, well, the average case is failure. Nobody's going to model out failure as the base case for any investment. But if you look at where the returns come in venture, half of your returns come from these massive outliers where you make 10 times your money back or more. Well, if half of your returns are coming from a highly unlikely outcome, a discounted cash flow makes no sense because the base case is failure and you're trying to model out something completely unlikely, a less than 4% chance. And yet, if you don't model out that 4% chance, the investment's not going to make any sense. So that's just why discounted cash flows don't make much sense in venture. I'm going to wrap up here by just mentioning one possible concern to be aware of, which is I mentioned here that you're seeing right now in the market over the past couple of years, a number of people have launched these evergreen private equity and venture capital funds. And if you look at what's happened in the market in the past couple of years, private equity and venture capital have had negative returns for the past couple of years. And I've mentioned a little bit of the concern around the stickiness, the price. For instance, the Stepstone product, the way they're setting their price, they've got 60 different traditional venture funds, and they're setting the price of the fund of funds based on the price reported to them by their venture funds. They can't do anything else. So there is a concern in a falling market environment where venture funds aren't and private equity funds aren't necessarily fast to respond to the market directly because they don't need to. There is a potential risk that in this falling market environment, some of the products, the price you're paying for the product may not be the true value of the price, and there may be some stuff to unwind in the future. So just something to be aware of. Are they taking overvalued assets? Are they taking them from the institutional market where they can't sell them as easily because the value is coming down? And are they trying to rebundle those same assets to the individuals market? Are they pricing them accurately when they do so? Or is there some inflation in the price? So it's just one thing to be aware of, but the trend itself is a good trend. That right now there's a trend to actually offer individuals access to venture capital and private equity. So the way the industry is going is good. The type of product which is being offered is a type of product which has features which are attractive to individuals. You just need to think hard and ask questions about valuation, what price you're paying for those assets, and does that price take into account everything that's going on in it? So there we go. That was the sort of the slides to start you off, and would love to now turn this over to a Q&A session. So we'll just see if there's been any questions put into the chat yet. So no questions put into the chat. So just feel free to stick your hand up or unmute even. I think there's few enough people here that if anyone has a question, we should be able to get to it. So any questions? Do feel free, don't be shy. Alice, I see you listening in there. Do you want to jump in? Is there anything you've wondered about listening to this talk?
I unfortunately was late starting, so my first slide was the valuation slide, which I thought was very interesting actually, because it comes up in my line of work to think about valuation as well. I wonder if you could, maybe I missed this part because I could have been in the beginning, but if you could share why this difference in valuation price has a practical implication for Loyal, perhaps on the fundraising side or in terms of how people perceive the fund.
Yeah. Well, that's a really good question. Um, the perception, how valuations are a perception and in many ways a marketing tool, because this this process of valuation, many VC funds, you don't know how much money you're getting back again until the fund closes down 10 years later. And because you don't know how much money you're getting back again in 10 years, people are always wondering early on, 3 years in, how is the fund going? So there's a lot of incentives for fund managers to be able to mark up their fund quickly over the first few years to show that they've got really wonderful returns, knowing that the long-term returns in 10 years may not be there, but they raise more money raised on what's going on. In fact, we've had conversations with a number of groups. I heard from one just last week, a fund of funds, who said, like what you're doing, Loyal, we like the process, everything seems good. When you have a 30% IRR, come back to us, but in between don't. And that is because of the inflation of IRR versus ROI. And we're sitting here reporting the money you're really making, the return you're really making from your money, not these paper markups. So you're right, on, there's a lot of pressure to look good. And therefore, if you want to look good, to try to find a way to report things in a way that makes you look good to make it easy to raise further funds. Now, I just mentioned that the first slide I showed talked about the past 10-year returns in venture and said the 10-year annualized returns in venture is about 15, and both private equity and venture is about 15%, whereas the US stock market has been at 13%. So private equity and venture doesn't outperform by a whole bunch. It outperforms by a couple of percent. And that's the, yeah. So you're right, there's a lot of pressure. We've just said, look, when there's a lot of honesty comes from being able to buy and sell every quarter at the price you set. For the past 2 years, we've reported negative returns. We've been down about 10% a year for the past 2 years. And yeah, some people don't like that. We've had a couple of investors who sort of said, I invested in this expecting excess returns. You've lost money for the past 2 years. But the whole point is if you run an evergreen fund, you have to report what's really going on in the fund, what the assets are really worth, because if you don't, you are no longer an evergreen fund. You are around for a couple of years till everyone finds out what your pricing is really like, and then you've lost all your investors and your fund shuts down.
Yeah.
So it is a very different incentive mix, which forces a lot more honesty in pricing, given that you have to, that anyone who wants can sell at any time. So therefore, if you set the price too high, if you set the price higher than the assets are worth, you're going to be taken advantage of by those sellers, and your fund will crumble.
Yeah. Yeah, there's that aspect too. Yeah.
Yeah,
It's not just marketing.
yeah, it is. It's interesting. Um, Tony, you've got a question here which says you were asked to do a DCF for a fundraising request with a VC, which contradicts the notion that VCs scoff at that. Any comments? Um, First comment I would make is there are different types and stages of VC. So when I talk about VC, I'm typically referring to the classical VC, who is a early stage funder funding companies when they are at a very risky stage. There's a lot of overlap between very late stage VCs and private equity. So if you're in the sort of the late stage growth VC versus private equity, then there's a lot they start to look more and more like each other. So I don't know if you're talking to a sort of traditional early stage VC where outcomes are unknown, or if it's a very late stage VC. I would also say there are VCs with different levels of sophistication, and you're absolutely right. When I talk about VCs scoffing at DCFs, I'm probably referring to sophisticated VCs. And there's lots of people who've raised money who are new to the space. They may have come from private equity, and even if they are a VC, they're used to these models. Now, a third factor, of course, could be your business. You may have a business which is a very low risk, very predictable business. I mean, we have one of our companies, for instance, which is building factories to recycle rubber. And when you're looking at something like investing in a factory to recycle rubber, the cash flows of that, once it's built, are very predictable. It's a very low risk activity. So it may be that the business being funded is seen as a much more low risk business and a very predictable one, in which case the DCF would make sense. We have a question here from Margarita. Margarita says, do I have a comparison of the performance of Stepstone versus Loyal and vice versa? Margarita, I should be able to pull that up. I don't have a slide on it, unfortunately. But if you want to follow up, I'll be happy to share it with you. The Stepstone product, our performance numbers have been similar, is the short answer. I mean, yeah, they're a diversified fund. We're a diversified fund. You should expect both of us to be industry-ish comparable. But I don't have that performance, and I should pull it up. So it's a good question. I will go look for that. I just don't think I can do it right now on the call. I mean, one of the questions which I do have on the Stepstone product is I personally have concerns. If you asked me, do I want to buy venture funds today, which are being priced at the price they're quoting to their LPs, I would have some hesitations on that. So while I don't know what their numbers are, yeah, I just have that concern about if and when the bubble will burst. That you buy something, the assets seem to be something, and is there future deflation in those assets? But yeah, I should still get their numbers. Any other questions?
Hi, Kamal. Can I ask a question?
Please, Rebecca.
You can hear me. I wanted to ask you a bit more in detail about evergreen funds in the climate tech VC, or sort of more, I suppose you could say, environmentally and socially sustainable focused VC funds in general. Because I know in the past couple of years, I think there has been I've seen a bit of discussion about how, given that a lot of climate tech or sustainability focused startups will be either looking at new technological innovations or trying out a completely new, more sustainable or more circular business model, they probably need a lot more time, many more years to really get up and running and growing, compared to, say, another social media platform or something that's can scale much faster. And so there's been discussion that maybe, an evergreen fund would be better to invest in climate tech startups, so that they don't have that pressure of, the VC needing to sell after 7 years, or the typical fund cycle. However, I know that there was and the name escapes me, but there was a climate tech VC fund, Berlin based, I think, about a year ago, that tried to raise an evergreen fund and ended up switching back to a traditional fund structure, because they just couldn't get the institutional investors kind of interested enough in the evergreen structure. And then I did also speak to a new VC kind of getting ready to launch their very first climate VC fund, and I asked her whether she'd considered going with an evergreen fund structure, and she said, no, didn't really cross my mind. Our investors, or the LPs, want a traditional fund structure. Myself as a VC founder, that's what I think is best as well, etc. So I just wanted to get your views on on that topic. Do you think there are
Sure.
reasons other than just the institutional investors aren't used to the evergreen so much, or do you really have to target more the high net worth kind of individuals and family offices who are more long-term thinkers? Kind of where do you see that discussion going?
Yeah, that's a really good question, Rebecca. So first of all, I spent the whole time here talking about how evergreen funds look like to the investor. If you want to flip it around and say, what does it look like to the entrepreneur? Um, Entrepreneurs will always appreciate a long-term focused investor who isn't forcing them to sell. And you're right that in a social media platform, you can pretend to people that you'll be able to sell it in 5 years, whereas many of these clean tech investments, that's just not a credible statement to make. Now, of course, the funny thing is that 40% of venture funds taking 16 years or more to liquidate their portfolios shows that even in businesses that we think can be liquidated early, often it just takes a lot longer to liquidate. Because it's not the right time to sell the business. I always look at my personal experience. I mean, my top angel investment gave me 30 times my money back, so I was a very happy camper. But it took me 14 years to exit that business. And if I tried to force an exit at year 10, I would have maybe tripled my money, but I would have lost a lot of the upside you get by waiting for the right buyer to come along at the right time. And this is exactly why I mentioned another venture friend of mine out of Europe who has still not liquidated his first fund because the biggest investment in there is doing really well, yet he can't easily liquidate it. So from the point of view of the entrepreneur, and some of these industries, yes, we need this longer term process makes sense. You have pinpointed exactly why people aren't doing it. If you think about how individuals think, individuals want liquidity. And we are very, very happy to have an evergreen product. The second you go into an institution, and I've spent 6 years pitching loyal to institutions as an evergreen product. And institutions are all about as an individual, you think about your own money. You're managing your own money, and you can afford to take risk on novel approaches like an evergreen fund. The second you are an institution, you don't have an upside if the institution you're investing for has a little bit of extra liquidity, but you've got a massive downside in trying something new. And there's a whole group of people who are busy saying, "Oh, I can't." The whole industry is built around, "Oh, we have no comparison. How can we properly compare an open-ended fund with a closed-ended fund? We can't do comparables." Oh, what if the liquidity doesn't work the way you've promised it? You said you're going to be liquid. And by the way, we've had 28 people so far. We've had 28 successful trades out of our fund. And everybody who's traded out, our gates are that 50% of new money in is reserved for people who'll be trading out. But we sort of cap it at the 50% of money in. We've had the gates come down a couple of times. Some people have had to wait 2 quarters to get their full order filled. Yet we filled every order so far in 2 quarters. But that is not a guarantee. The second I say it's a market-based mechanism where you adjust the price until the market clears, that's really uncomfortable for someone sitting at a institution because they go, well, I'm hearing that there's no guarantee. I'm hearing that the market might never clear. And it's like, that's not how markets work in reality, but they're looking for a guarantee and they're just not getting that guaranteed liquidity mechanism. So they would prefer the paper guarantee of a fund shutting down in 10 years, even though the odds are that fund will shut down in 15 to 20 years, but they would prefer that paper guarantee because it feels safer. It feels And it's the way things are done. I mean, the other challenge is too, institutions have an investing team and a compliance team. And I've heard multiple times from investing teams, we love your approach. We have some interesting things we do in our investing approach with staged funding and trying to optimize follow-on investing, et cetera. We've had a number of people say, we love your approach. As the investing team, I would go for this, but I'm never going to get this through compliance because they don't know how to do it. So we are faced with a little bit of just friction in this market, which is individuals want this. It's hard to raise a fund from individuals. We have over 240 investors so far, and we're only a $30 million fund. And normally, if you were raising from institutions, you'd have 5 institutions, you'd have a $30 million fund. So we're just running a fund a different way, focused on individuals. So my advice to any VC doing this is, yeah, if you're going to do a evergreen fund, target individual investors, and then you're taking small checks, and you're going to have to wait 5 years till institutions are ready to do this.
Thanks very much.
Yeah, very welcome. Any other questions? Good. Last call for questions here. Meredith, I see you've had your camera on. I don't know if that means that you wanted to ask a question or not.
I don't have a question, but I learned a lot. This is very informative. Thank you.
Very welcome. Alvaro, I see you just turned on. Did you have a question?
Yeah, sure, Kamal. As always, it's a pleasure to listen to you. Unfortunately, I joined late in the call, but just by answering the question of the previous question was, amazing to hear you out. And thank you for that true and honest response. In terms of geography, have you seen like, I don't know, Middle East or Europe or Asia or any other jurisdiction where makes sense to think about incorporation of the fund or in terms of LP, or are there any other areas, geographies that are pursuing in the open-ended fund strategy?
Good question, Alvaro. No, I haven't. I have yet to find a jurisdiction where open-ended funds are sort of a common thing to do. There are, well, for instance, I mean, we run as a Canadian fund, and there are exemptions for venture capital funds from certain pieces of the legislation. For instance, registration as an exempt market dealer, which other venture funds are all exempt from registration as exempt market dealer. Yet we are not exempt because we set a price every quarter, and because there's a price every quarter, that is a more legislated activity. And we therefore process all trades through a Canadian licensed exempt market dealer. So no, and legislation tends to follow rather than lead. They're relatively, now you might hypothesize that jurisdictions like sort of an Abu Dhabi, Dubai, even a Singapore, who try to innovate more in regulation, may be earlier ones to do this, but you can do an open-ended fund. It's the nice thing is, when we went to our lawyer to set up this open-ended fund back in 2018, she sat down and said, oh, well, this is not done in venture capital, but it is done in the hedge fund business. So let me see how I can take everything I know from hedge funds and other types of funds and combine it with venture capital funds to find the path for you to legally set up this open-ended fund. And I would certainly say there's a lot of jurisdictions in the world where if you have a really good lawyer, and we certainly have one of the top in the industry in Canada, if you get a really good lawyer, they should be able to walk their way through this path, if just by the similarities with the hedge fund business. Because let's face it, hedge funds have been doing this for years because this is how individuals want to buy product. Good. All right, so I know a number of you did join late. We are recording this session, so we will be circulating a link to the recordings. If you want to flip back and hear the first few minutes, which you may have missed, do look for that in the recording. Last chance for questions. If there's any other questions, we'll take them. Otherwise, we'll wrap things up here.
Quick one, Kamal.
Yes.
Have you ever regretted to create an open-ended fund?
Oh, I've regretted an open-ended fund all the time. It's like yes, we've regretted over and over. It's funny, we've actually looked at launching a closed-end feeder fund that would buy units in the open-ended fund. And we just have never got that off the ground with a suitable lead investor. And we're just so committed to the core fund is going to be, we don't have the resources to be able to run two parallel funds right now. So if we had the staffing, the people who would run a closed-ended fund, we probably would have one. And but look, I'm an entrepreneur at heart, and entrepreneurs, when they see a market opportunity, tend to want to fill it. And I see Michael and I, when we launched our fund, said we wanted to build the venture fund we would invest our own money into. And there is this massive opportunity for people like Michael, myself, and probably most of you on the call here to want to invest in venture capital, but just don't have a fund which is structured in a way that you can easily make that investment. And that's really so as an entrepreneur, even when it's hard, when you're committed to your vision, and you know the market is out there. I mean, 240 different people who said, yes, thank you, I want to buy a product like this. So we see the future. It's really nice to see the market moving in our direction in the past 2 years. But there have been regrets many times just because it's been a lot harder. As an entrepreneur, it's a lot harder to follow a new path than it is to just sort of do the same old way, the way everyone always does it for the existing market. All right, good. Thank you very much, everyone, for attending this. Hope you found it interesting and informative. And Cassidy will be following up with you to forward on the recording. So thanks very much for your time. Bye for now.